Welcome. This is David Perron. Artificial intelligence is no longer a peripheral tool in finance. It is a core driver of value, embedded in every aspect of modern banking and insurance, from algorithmic trading and credit scoring to fraud detection, asset management, and customer service automation. But as AI's capabilities expand exponentially, so does the regulatory scrutiny. We are at a critical juncture. The European Union has rolled out the world's first comprehensive AI legislation, the AI Act, while the United States pursues a fundamentally different path, a complex, sector-specific, and state-led regulatory patchwork. Misinterpreting these frameworks is not merely a compliance risk. It is a strategic one, with penalties under the EU AI Act reaching up to 35 million euros or 7% of global annual turnover, whichever is higher. In this briefing, we will move beyond the headlines and the superficial summaries. This is an executive-level analysis designed for risk officers, compliance leaders, chief technology officers, and board members who need to understand not just what the regulations say, but what they mean for your institution's strategic roadmap. We will dissect the EU AI Act's risk-based approach and, critically, its phased implementation through 2026. We will contrast this with the evolving regulatory landscape in the United States, where the recent revocation of Executive Order 14110 has shifted the balance toward deregulation and state-level innovation. And most importantly, we will outline a strategic framework for classifying your AI systems, understanding your obligations, and preparing for compliance. This is not a summary. It is a strategic guide for leaders navigating the new era of AI in finance. Let's begin with the EU AI Act, Regulation 2024/1689. This is the global benchmark, and its influence will extend far beyond Europe's borders. The Act's extra-territorial scope is critical to understand. It applies to any AI system whose output is used within the EU, regardless of where the provider is located, where the system was developed, or where the data was processed. If your AI system affects an EU citizen or resident, you are in scope. This is a Brussels effect in action, and it will shape global AI governance for years to come. The Act's implementation is phased, and understanding this timeline is not just important, it is mission-critical for your planning. The regulation entered into force on August 1, 2024, 20 days after its publication in the official journal. However, different provisions apply at different times, creating a staggered compliance roadmap. By February 2, 2025, 6 months after entry into force, the prohibitions on unacceptable risk systems came into effect. These are AI systems that are deemed to pose such a fundamental threat to human rights and safety that they are banned outright. This includes systems for social scoring by governments, real-time biometric identification in public spaces by law enforcement, except in narrowly defined circumstances, and AI systems that deploy subliminal manipulation techniques. For the financial sector, these prohibitions are largely not applicable, but understanding the red lines is important for your broader AI strategy. By August 2, 2025, 12 months after entry into force, the rules for general-purpose AI models, or GPAI, will apply. This is Article 53 of the Act. These are foundational models, large language models like GPT-4, Claude, or Gemini, that have broad capabilities and can be adapted to a wide range of tasks. If your institution is developing or deploying such models, or if you are relying on third-party GPAI providers, you need to understand the transparency and documentation requirements. This includes publishing a sufficiently detailed summary of the content used for training, establishing a policy to comply with EU copyright law, and, for models with systemic risk, conducting model evaluations and adversarial testing. By August 2, 2026, 24 months after entry into force, the full force of the regulation will apply. This is when all obligations for high-risk systems, as defined in Annex 3, become mandatory. This is your critical deadline. You have a 2-year runway from August 2024 to August 2026 to achieve full compliance for any high-risk AI systems. This is not a long time in the context of enterprise transformation, and the clock is ticking. Finally, by August 2, 2027, 36 months after entry into force, even legacy high-risk AI systems that were placed on the market before August 2, 2027, must comply. This means you cannot simply grandfather in your existing systems indefinitely. They will need to be brought into compliance or decommissioned. The AI Act does not exist in a vacuum. It forms a regulatory trinity with two other major EU regulations: GDPR, the General Data Protection Regulation, and DORA, the Digital Operational Resilience Act. Understanding the interplay between these three is essential. GDPR governs the personal data that you use to train and operate your AI systems. It sets the rules for data minimization, purpose limitation, and individual rights. DORA, which applies from January 2025, mandates operational resilience for your digital infrastructure, including your AI systems. It requires you to manage ICT risk, report incidents, and conduct third-party risk assessments. The AI Act, in turn, specifically governs the AI system itself as a product or service. It sets requirements for the design, development, and deployment of AI. Your compliance framework must integrate all three. You cannot treat them as separate silos. Now, let's focus on the core of the Act for the financial sector, the high-risk classification. This is where the rubber meets the road. Annex 3.5 is our primary text. It explicitly designates two categories of AI systems in banking and insurance as high risk. First, AI systems intended to be used to evaluate the credit score or creditworthiness of natural persons. This is broad. It covers traditional credit scoring models, but also newer AI-driven approaches to assessing creditworthiness, including alternative data models, behavioral analytics, and machine learning models that predict default risk. If your AI system influences a lending decision for a natural person, it is almost certainly high risk. Second, AI systems intended to be used for risk assessment and pricing in relation to natural persons in the case of life and health insurance. Again, this is broad. It includes underwriting models, pricing algorithms, and claims prediction systems. However, and this is critical, the Act provides for exceptions. An AI system that would otherwise be high risk is exempt if it does not pose a significant risk of harm to the health, safety, or fundamental rights of natural persons. The provider must document this assessment. This is not a blanket exemption. It requires a formal, evidence-based risk assessment that you can present to regulators. More importantly, and this is a point that many practitioners have missed, Annex 3 explicitly carves out an exception for AI systems intended to be used for the purpose of detecting financial document and network security fraud. This is stated in point 5, subpoint B. This is a significant clarification. It means that your AML systems, your transaction monitoring systems, your fraud detection algorithms, even if they use sophisticated AI, are not classified as high risk under the AI Act. They remain subject to AML and CFT regulations, of course, but you avoid the full burden of high-risk compliance under the AI Act. This is a major relief for the industry, and it allows for continued innovation in this critical area. For systems that are confirmed as high risk, the obligations under Articles 9 through 15 are substantial. This is not a checkbox exercise. It is a fundamental shift in how you design, develop, and deploy AI. Let me walk through the key obligations. Article 9 requires a risk management system. This is not a one-time assessment. It is a continuous, iterative process throughout the AI system's lifecycle. You must identify and analyze known and foreseeable risks. You must estimate and evaluate the risks that may emerge when the AI system is used in accordance with its intended purpose and under conditions of reasonably foreseeable misuse. And you must adopt suitable risk management measures. This framework should align with international standards like ISO 31000 and the NIST AI Risk Management Framework. Article 10 mandates data governance and management practices. Your training, validation, and testing datasets must be relevant, representative, free of errors, and complete. You must take into account the geographical, behavioral, and functional setting within which the AI system is intended to be used. And you must implement measures to detect, prevent, and mitigate possible biases. This is where fairness and non-discrimination come into play. You need robust data quality controls and bias testing frameworks. Article 11 requires technical documentation. This must be drawn up before the AI system is placed on the market or put into service, and it must be kept up to date. The documentation must include a general description of the AI system, a detailed description of the elements of the AI system and the process for its development, detailed information about the data used, the monitoring, functioning, and control of the AI system, and the results of the testing and validation. This is a comprehensive technical dossier. Article 12 mandates record-keeping. High-risk AI systems must have logging capabilities that enable the automatic recording of events, or logs, over the lifetime of the system. This is essential for traceability, auditability, and post-market monitoring. Article 13 requires transparency and provision of information to users. Users must be able to interpret the system's output and use it appropriately. You must provide clear and adequate information, including the system's capabilities and limitations, the level of accuracy, and the conditions under which the system can be expected to achieve that accuracy. Article 14 is perhaps the most important: human oversight. High-risk AI systems must be designed and developed in such a way that they can be effectively overseen by natural persons during the period in which they are in use. This means that humans must be able to understand the system's output, to intervene in the system's operation, to decide not to use the system, or to override a decision made by the system. This is the principle of human in the loop, or human on the loop. It is a fundamental safeguard against fully autonomous decision-making in high-stakes contexts. Finally, Article 15 requires accuracy, robustness, and cybersecurity. High-risk AI systems must achieve an appropriate level of accuracy, robustness, and cybersecurity throughout their lifecycle. Let's now turn to the United States. The regulatory landscape here is fundamentally different. In contrast to the EU's horizontal, comprehensive approach, the US operates a vertical, sector-specific, and state-led regulatory patchwork. There is no federal equivalent to the AI Act. There is no single law that governs AI across all sectors and all use cases. Instead, existing agencies apply their existing authority to AI systems on a case-by-case basis. For the financial sector, the primary tools are the existing consumer protection laws. The Equal Credit Opportunity Act, or ECOA, prohibits discrimination in credit transactions on the basis of race, color, religion, national origin, sex, marital status, age, or because an applicant receives public assistance. The Consumer Financial Protection Bureau, or CFPB, has made clear that ECOA applies to AI-driven lending decisions. If your algorithm produces discriminatory outcomes, you are liable regardless of whether the discrimination was intentional. The Fair Credit Reporting Act, or FCRA, regulates the use of consumer credit information. It requires accuracy, fairness, and privacy of information in the files of consumer reporting agencies. This applies to AI systems that use credit data. This creates a complex compliance matrix. A bank operating nationwide must contend with California's Consumer Privacy Act, or CCPA, and its successor, the California Privacy Rights Act, or CPRA, which grant consumers extensive rights over their data, including the right to know, the right to delete, and the right to opt out of the sale of their data. It must also navigate Colorado's Privacy Act, New York's SHIELD Act, and a growing number of other state-level privacy and AI-specific laws. The challenge is not a lack of rules. It is a multiplicity of them with varying definitions, varying obligations, and varying enforcement mechanisms. The December 2024 Treasury Report on AI in Financial Services provides a clear view of current regulatory priorities. The report synthesized input from 103 comment letters from industry participants, consumer advocates, and other stakeholders. It identified 3 key risks that regulators are focused on. First, algorithmic bias and discrimination. AI models can perpetuate or even amplify historical biases present in training data. Regulators want to ensure that your systems do not discriminate against protected classes. Second, lack of explainability. Many advanced AI models, particularly deep learning models, are black boxes. It is difficult to explain why they made a particular decision. Regulators and consumers want to understand. Third, and this is increasingly important, market concentration. The report highlights the systemic risk posed by the reliance of the financial sector on a small number of large technology providers for foundational models, cloud infrastructure, and AI services. This creates concentration risk, vendor lock-in, and potential single points of failure. This suggests that future regulatory actions may focus on third-party risk management, vendor due diligence, and operational resilience for AI providers. So, how do you translate all of this into a concrete strategy? It begins with a rigorous, multi-step classification of your AI inventory. You need to know what AI systems you have, what they do, where they operate, and what risk category they fall into. Step 1. Establish jurisdictional nexus. Does the AI system's output affect individuals or entities in the EU? If so, the EU AI Act applies, regardless of where your institution is headquartered. Step 2. Conduct a use case mapping against Annex 3. Is the system used for creditworthiness evaluation of natural persons? Is it used for risk assessment or pricing in life or health insurance? Be precise. The classification depends on the intended purpose of the system. Step 3. If it is a listed use case, evaluate the significant risk exemption. Can you formally document with evidence that the system poses no significant risk to fundamental rights? This is not a subjective judgment. It requires a robust, evidence-based risk assessment that you can defend to regulators. Step 4. Determine if your system is, or is built upon, a general-purpose AI model. If you are using a large language model or a foundation model as part of your system, you need to understand the GPAI obligations, even if the final use case is not high risk. Step 5. For US operations, map your systems against ECOA, FCRA, and applicable state privacy laws. Identify where you have exposure and what controls you need. Your strategic takeaway should be this move from a reactive, compliance-driven posture to a proactive, risk-based governance model. Establish a cross-functional AI governance committee that includes legal, compliance, risk, technology, and business leaders. This committee should have executive sponsorship and board oversight. Invest in talent that understands both the technology and the regulatory environment. This is a scarce skill set, and you will need to compete for it. Build your AI systems on a foundation of transparency, fairness, and accountability from the design phase. This is not just about mitigating risk. It is about building trust with your customers, your regulators, and the public. And ultimately, it is about ensuring the long-term viability and competitiveness of AI in your institution. Disclaimer: the information provided in this podcast is for general informational purposes only and does not constitute legal or professional advice. The interpretation and application of laws and regulations can vary widely based on the specific facts and circumstances involved. You should consult with qualified legal, compliance, and technical professionals for advice on any specific legal or compliance matter related to your organization. The author, David Perrone, and the producers of this podcast assume no liability whatsoever for any actions taken or not taken based on the content of this podcast. This podcast is not a substitute for professional advice. Thank you for listening.